Hi there. Welcome to Morning Markets. I'm Lindsay Biscaya. Here's some of the stories that we're tracking for you in the BNN Bloomberg newsroom. Canada's Financial Consumer Agency has fined the Bank of Montreal. The $4 million fine is for overcharging customers after failing to properly disclose fee details. The penalties relate to discontinued bank accounts for newcomers, medical and dental students, and Indigenous clients. Now, the watchdog says more than 100,000 customers were impacted between 2010 and 2024. Shares of Canadian Pacific Kansas City are edging higher today. The rail operator set a new record for shipping Canadian grain and grain products in January, both by amount and by carload. CPKC says an effective crop year, winter planning, and demand forecasting helped it prepare for the month. Last week, the rail company also reached a record high in the fourth quarter grain revenue, driven by a bumper crop. And shares of PayPal are taking a hit. The financial tech company says Chief Executive Officer Alex Chriss will be replaced after his turnaround plan failed to meet targets and streamline the business. He will be replaced by HP CEO Enrique Lorez. Additionally, PayPal posted profit and revenue in its latest quarter that missed estimates due to weakness in U.S. retail spending and international headwinds. And we'll take a look at the markets this morning. The TSX is up by a percentage point. Material stocks leading the way today. Also, gold prices are up, which is, of course, bumping the TSX up. If we take a look at the U.S. markets, mixed trading. Today, S&P 500 is down by 0.3%. The Dow Jones also is up, actually, by 0.1%. And the NASDAQ is down by almost a full percentage point. Robust earnings from Palantir Technologies have sparked a rally in technology stocks, while PepsiCo and pharmaceuticals like Pfizer and Merck & Co. all reported earnings this morning. And for his analysis, we spoke with Greg Newman, Senior Wealth Advisor and Portfolio Manager at Newman Group, Scotia McLeod.
You know, it's one of these companies that so much hype, right? And it got towards $200. And there's been, you know, a little bit of I suppose, healthy fear and skepticism over the last couple months, and the stocks pulled back a little bit. But this is one of these for real companies. I mean, it's tough. It's tough. It's growing at, you know, maybe 30, 40%, but it trades at around 121 times PE. So it's very hard for people to get their head around. However, if you look at it on the rule of 40, which is revenue plus margins, you know, for software companies, they want to see greater than 40. These guys are at 127, so they're really blowing it away. And you know, they're really making America, you know, and its defense complex a lot more lethal. So they're really, really good at what they do, and the market is really applauding them for their earnings last night.
It's an expensive company, right? The Palantir are the most expensive on the S&P 500. So are you surprised at kind of like when it's doing well, like in terms of this latest earnings report, other tech stocks are kind of rallying behind it?
So there's no question. That's a great question. You know, how much bullishness is out there, and is this kind of a gauge of that? To a certain extent, yeah. I mean, we're not in a euphoric camp for AI right now. I would say that we're in a more sober environment than we were like maybe 3 months ago, 4 months ago. But I think that Palantir deserves to be trading where it is right now. And, you know, it's a high-risk name. I don't think you want it necessarily in your RSP, but I think you can still buy this name for growth.
Okay, let's move to another company, PepsiCo. Earnings coming out today, and as we were just saying in the headlines there, cutting Lay's Dorito prices as much as 15% to try to boost sales. I mean, what are your takeaways from PepsiCo?
You know, they still got this activism involved from Elliott Management that's trying to fix their lineup.
Elliott Management is just involved in so many.
They're kind of in everywhere, right? They are. You know, I like that they're doing their buyback. I like that they beat. But really, when you step back, you know, it's a pretty pricey name for its growth. It's trading around 20 times, growing around 7 or 8%. Look, I think there's better alternatives in the market for investors than PepsiCo right now.
You do? Okay. Okay, let's go to the healthcare sector. Pfizer and Merck & Co. Do you want to start with Merck & Co.? I mean,
sure.
They reported today, too. shares dipping?
The knock on this stock, and it was, dead money for a long time, was that people are really concerned about Keytruda and that patent coming off in 2027. And I think the market wasn't really realizing that they really are filling up their pipeline pretty well, and the stock got too cheap. And I think that, that was around $80. Now the stock's had a big run. Today, their earnings look okay to me. I think that this is a well-priced name for its dividend, for a price to growth. I think you can buy this name.
What about Pfizer? So Pfizer reporting, are they still kind of in the top there?
Well, no, they really blew it with, they bet everything on, or too much on COVID, and then Paxlovid, and that kind of fell apart. People are really worried about their pipeline as well, but they're really moving into oncology. And the thing about Pfizer is it's very cheap, pays a great dividend of 6 or 7%. No real growth yet, but it's interesting from a value play. I like Pfizer as a value play and getting paid real nice dividend to wait.
Yeah, dividend.
So I'd buy that.
You buy that? Okay, 6.45% is the yield right now. PayPal also reporting today, replacing their CEO. Is that a smart move at this point?
Well, listen, somebody's going to make money on that at some point. It depends what your time horizon is. I think they got to be a takeout play or something like that. I mean, they got too many competitors. They got Visa, Square, Stripe, Shopify, Venmo. I mean, everybody's in that space. Apple Pay. It's very cheap. It's very cheap. Its earnings are around 531. Stock's trading at 44. It's PE under 10. But this has just been one of those classic value traps. You could have said the same thing about the stock at $70. Now it's like dipping down to 44. So yeah, at some point you want to buy it, but and somebody's gonna. There's many different ways to make money in markets, and this is one. If at some point this is going to get overdone, but it's not for me. I'm avoiding it.
You're avoiding it.
I'm avoiding it.
All right. So these are the big ones. We kind of went over the big market movers for the morning. But I mean, if you take a more general look at the markets, like we were talking off air before we started, it feels like January was a lot longer than just 1 month, right? There's so much volatility in the markets. It seems as though February, we're on the third day, so maybe early to say, it's a little calmer. A little less volatility? Or
well, I don't know. Disagree? I mean, yeah, I guess so, because January 31st was a real banger, right? Like, I mean, look at that. Like, silver fell 30%. So, I mean, that's a nice crescendo to the end of the month. So far, things have been really good.
3 days in to February.
February. But if we're talking like earnings season thus far. Right. Earnings season thus far, have come in around 15%. And most, I think 80% of the companies have beaten. So I think so far, the bull thesis is holding of not crazy inflation, relatively tame inflation, and really good earnings and a good economy. Not that there's not knocks on that, not that there's not problems with the consumer, but people are still spending. And that's the U.S. story. And I think the Canadian story from all this nation building and all this kicker in metals has even been better. So, you've had a 30% pullback in silver, but these silver companies are going to just mint incredible margins and free cash flow. Now, whether that's enough for these stocks to go forward after, what's going on in the metals market and what it means in terms of the U.S. dollar and the basement trade and what's really going on there and the new appointed Fed that's likely. I mean, there's a lot going on that we can discuss whether or not we should still be buying those metal companies.
That was Greg Newman, Senior Wealth Advisor and Portfolio Manager at Newman Group, Scotia McLeod. Up next, shares of Pfizer are under pressure despite a fourth quarter revenue beat. We've got details on that right after the break. Pfizer posted a fourth quarter revenue beat driven by strength in several of its core blockbuster drugs, but shares of Pfizer are under pressure today. We're going to find out why. Joining us to walk through the results is Evan Seekerman, Managing Director and Head of Healthcare Research at BMO Capital Markets. It's good to have you join us. Thanks so much.
Thank you for having me.
So let's just go over the results to start. Anything jump out at you in these latest results?
I mean, we do the guidance for 2026, so that wasn't a surprise, but I'm going to get right to it. It's the Vesper 2 data that we're all talking about. The Vesper 3, excuse me. This is their long-acting GLP-1 from the Metsera acquisition. I think the TLDR is that it underperforms tirzepatide, which we would expect because it's a single agonist. But I think the positioning around where this actually fits in a rapidly evolving obesity treatment landscape is still somewhat nebulous to us.
Yeah, I'm wondering where it does fit because, the Vesper 3 is their kind of experimental weight loss drug. Is it a little too late to get into this weight loss game, do you think?
I don't think so. I think there is a need for longer acting, so that's why this product could be very interesting. Although, patients really are focused on that absolute weight loss. That's why tirzepatide is still the leader, or Zepbound. I think that Pfizer is going to have to figure out how to position this and really develop it quickly to get to the market as soon as possible, then also combine it with things like amylin, so you get a product that continues to push weight loss into the mid-20% weight loss, but also allows people to maintain that weight loss using something less frequent like this asset.
What about the other core blockbusters that Pfizer have? Are they doing enough to kind of offset the COVID declines that the company's been seeing since the pandemic?
I mean, some things that we're looking at, kind of Padcev looks okay. We did ask management kind of about that in a pre-call. I think that more broadly in the business, you're seeing a bit of struggle. I think that there are some really interesting opportunities, but it's clear to us that 2026 is a year of investment. They highlighted on the call that they're divesting from their partnership with GSK under ViiV for HIV medication, giving them some more cash kind of to free up to cover that dividend. But it's going to be a lot of investments, and I think you're going to need those free cash flows across the board to support the investments, especially in things like obesity and oncology.
You talk about those investments and the guidance for 2026. How important was the revenue beat today relative to that guidance, do you think?
I mean, listen, we knew the guidance, so it wasn't a big surprise. We got that in December of last year. So I don't think the revenue beat was, as interesting as the Vesper 3 data. I know I'm going back to obesity, but that's what everyone's focused on today. But more broadly, how they maintained their free cash flows for the dividend. I can't emphasize enough. That's kind of the reason why a lot of investors hold on to the stock even right now.
What should investors, I know you keep going back to the obesity data. I will as well. What should investors make of that new data that we're seeing from Pfizer?
We frame it as it shows that the asset's working. It shows that you're able to get good efficacy at a once monthly. I think what was odd to me was that they had some model data, which is something we don't typically see, showing what they believe could be better efficacy at a higher dose. So that will have to play out. But what's most important is where does this fit in? They need to combine it with amylin. So we need to see a product that is differentiated from the once weeklies we currently have. There's also a lot of competitors in that market too. Most definitely. You have Novo, Lilly, of course, you have Roche, for example, and a lot of smaller players. And clearly, everyone wants a bit of this pie. I mean, we forecast it to be across diabetes and obesity and related conditions, upwards of 150 billion. So even a small portion could be meaningful to a top line number for someone like Pfizer. So what then? If we're staying in the weight loss conversation, what would Pfizer have to do to separate themselves from that competition, do you think? A few things. One, show that a once monthly allows for once weekly like efficacy. I think that's the first thing. The second thing is they're going to have to really figure out how to commercialize this. That's what's key. That's what Lilly and Novo are leaning hard into, figuring out the DTC channel, direct to consumer, figuring out how to get this to as many patients as possible worldwide. This isn't a typical launch product where you go through the insurance companies or government reimbursements. We're seeing a lot of DTC use, and that's how you get to the volumes that are going to be required to get to those big, big numbers. So interesting. Just lastly, I know you mentioned we saw the guidance before, but this reaffirmed 2026 guidance, how comfortable do you think investors should be with that? I think most folks are fine with the guidance. There's definitely some room for them to push it. That was my question on the call back in December. And I know the CFO is usually pretty conservative with how he talks about things at the beginning of the year, so that's a good thing. I think that we're going to be focused on some of the commercial assets, especially Padcev from their acquisition of Seagen. Right, these bread and butter assets are really important for the near-term just revenue story as they deal with some of the LOEs in the coming years. Okay, we will leave it there. Appreciate you joining us today. Thanks so much. Thanks for your time.
And that was the head of healthcare research and senior biotechnology and biopharmaceutic analyst at BMO Capital Markets. Coming up, we'll have a look at the latest market movers with Bloomberg's Monique Mulima right after this. Welcome back. For some of today's market drivers, we are now joined by Bloomberg Equities reporter Monique Mulima to dive into the. Monique, good to see you. So we'll start with Galaxy Digital, big loss for the company. What's going on there?
Hi, yes, thanks for having me. So like you mentioned, Galaxy Digital, they had a big loss. They reported their fourth quarter earnings today, and it was over a $400 million loss. And this was much wider than analysts had been expecting. The main driver of this loss was the decline in crypto prices during the quarter. The company's impacted on lower crypto prices because that can mean that users are going to be trading less and there's less transaction revenue. But they're also impacted because the company itself holds hundreds of millions of dollars of crypto on its balance sheet. So they also see the fair value of that decline when crypto prices go lower in the quarter. But what analysts are noting is they are seeing some bright spots. The company has a data center business, and they see a lot of opportunities for growth there. They think there's going to be more customer demand going into future quarters, and they think this can be a driver to kind of offset some of that weakness in the crypto space.
Interesting. Okay, we're also watching shares of Sable Offshore under pressure today, down more than 9% at the moment. What's the story there?
Yes, so Sable Offshore, they are an energy company that's working on a pipeline in California, and they announced today a $250 million at the market offering. So this means that they can sell shares from time to time up to $250 million worth, and that really put pressures on shares this morning. The company also announced in a filing that they have received subpoenas from the Southern District of New York and the Securities and Exchange Commission, and that they're cooperating with that. The company is also doing its own investigation, its board, into some allegations from a Hunter Book report that was earlier this year. So that's also compounding some of these declines that the company is seeing today.
And lastly, Sigma Lithium getting a boost. Last I checked, it was up almost 15%.
Yes, so Sigma Lithium, their shares are higher today. They were upgraded at Bank of America this morning, with the bank seeing new opportunities now that the company's mining operations have restarted. They said that this was something that had been an overhang on the stock and now has been removed. They think that they could reach nameplate production within the next 3 months and that this should reduce the risk of delays. They note that there is still liquidity concerns with the company, but they see a lot of opportunities for them going forward and think that they're now more fairly valued, which is why they were upgraded to neutral. And we're also in just the metal space in general seeing a big boost today, so they're getting some help from that as well.
Okay, interesting stuff. We will leave it there. That's Bloomberg's Monique Mulima joining us live. Thanks, Monique. The Port of Churchill, located in Manitoba on the Hudson Bay, is North America's only deep-water Arctic seaport with direct rail access, but the port's future is not set in stone. CTV's Allison Bamford reports.
Those who've lived in Churchill, Manitoba long enough remember the days of a bustling port.
Churchill and the port are pretty synonymous with each other.
Joe Stover worked there for 10 years at the tail end of its glory days.
That was going to be my retirement job.
The port currently operates just 4 months of the year. Ottawa has flagged it as a transformative project known as the Port of Churchill Plus. The project would upgrade it to a year-round multi-commodity hub, connecting Western Canada to the north and the Atlantic through Hudson Bay.
It would mean everything. It would mean everything to get people back to work and have an opportunity for our youth to stay here if they choose and make their living here.
Since the port slowed, tourism has become the main economic driver.
In a given year, we have upwards of 25,000 visitors that come to Churchill.
They're flocking to the polar bear capital of the world for the wildlife and the northern lights. The Chamber of Commerce says any port upgrades would have to strike a balance with the tourism industry.
Churchill has a lot of land-based research. I had it for many years, and we're also gaining water-based research. And so right now is a great time to put that all together.
Manitoba's premier is set to visit the remote community tomorrow to hear what residents have to say about the port's future, which for right now is still not set in stone. But community leaders say it's time to act.
Diversification is critical, it's key. We can't succeed on just tourism.
Manitoba's premier will touch down on the frozen tundra tomorrow. On the agenda, talking tourism, marine conservation, and a town hall with residents before he plans to play some hockey with the locals. Allison Bamford, CTV News, Churchill.
Merck shares are trading higher. We will tell you why right after the break. Stay with us. Canada's Financial Consumer Agency has fined the Bank of Montreal. The $4 million fine is for overcharging customers after failing to properly disclose fee details. The penalties relate to discontinued bank accounts for newcomers, medical and dental students, and Indigenous clients. The watchdog says more than 100,000 customers were impacted between 2010 and 2024. PepsiCo shares are higher today after topping fourth quarter revenue expectations. The quarter benefited from robust demand for its sodas in international markets, as well as strength in its low-sugar beverages in the U.S. Pepsi says it's cutting prices by as much as 15% in some of its key brands, including Lay's and Doritos, in a bid to lift sales by offering more affordable products. And shares of Disney are down today after the media and entertainment giant said Josh DeMarco will succeed Bob Iger as CEO. DeMaro's the current head of Disney's theme parks division and will begin his new role in March. Disney has been searching for 3 years to replace Iger and says he will stay on the board and serve as a senior advisor until his retirement in December. And we'll take a quick look at the markets now. The TSX is up by 0.6% today. Of course, the price of gold up, which usually boosts the TSX. And if we take a look at the U.S. markets as well, you can see mixed trading today at the moment. S&P 500, Dow Jones, and NASDAQ are all trading slightly down. Merck & Co. is in focus after posting a fourth quarter earnings beat, but delivering a full year 2026 outlook that missed expectations. Shares are trending higher as a result, and joining us to walk through all of the results is Rajesh Kumar, head of the European Life Sciences and Healthcare Equity Research at HSBC. It's good to have you join us. Thanks so much.
Hello.
Okay, so I guess, first of all, what jumped out to you in the latest earnings report?
We've had a lot of deals with the U.S. administration on drug pricing. And when we look at the guidance which the companies have issued so far, there is no material impact on margins so far, right? So that is sort of reassuring for investors. We are back to a zone where healthcare investment has become quite a bottom-up exercise again. So you can start looking at what the company's pipelines are doing, what patent cliffs are coming, which drugs are growing and which drugs are not. And last year was entirely about, what the MFN or, the tariffs are going to do to the industry. So we've crossed the wall of worry. On the other side, we are trying to figure out where can we find growth in the sector. There's a lot of excitement around growth. And in terms of the guidance so far from the companies, there hasn't been a massive shock. And that's a bit reassuring for a lot of investors.
So you talk about growth and where we can see growth in the company this year. Where do you think that growth is going to come from for the most part?
I think a lot of people are very excited about obesity. We are not as excited as the rest of the street, but clearly you've got headwind from the pricing deals we have seen in the first half of the year, and then we'll see how much volume unlock comes through. And the street has sort of made the assumption that the volume unlock will come through and orals will add on top. So there's a lot of excitement around obesity. There's a bit of concern around, vaccines. The market is sort of rethinking how much growth they should have on vaccines. But some of the cancer drugs, especially second generation immuno-oncology, but they can potentially be quite a meaningful growth driver in the medium term without, the complication of obesity markets with compounders, with pricing and all of that. So oncology potentially, and especially second generation immuno-oncology seems super interesting.
Why, I want to talk about some of the top drugs in a moment, but you mentioned you're not as excited about obesity and weight loss drugs for this company. Why is that? Is it because of pricing?
See, the reality is we are at a point where we have just scratched the surface of the entire market, right? But we also have an unfortunate situation where compounders came, and then also with the US drug pricing deal, this market is not behaving like a traditional innovative drug market. It's become more of a consumer market. The prices have come down a lot faster than any of us had expected. And effectively, what we now need is a Nike swoosh. We need the volumes to go up. But for the volumes to go up, you are either depending on out of pocket, or you're depending on the employers and the payers to unlock value, but unlock reimbursement. But the real question becomes is that at the moment we have had the price reset in the government channel. What is the leakage to the sort of private channels in the US from that? So there are few uncertainties in the near term which you do have to think through when you're thinking about the obesity market. And at the moment, everyone is sort of so excited about orals is, they're sort of ignoring the fundamentals here.
Interesting. Okay, so obesity market and weight loss market aside, are there any kind of newer products that are standing out to you when it comes to Merck, or is it still the same strong drugs? Like Keytruda was one of their top cancer drugs as well.
I'm extremely sorry. The voice broke off. So I was talking more about overall industry rather than Merck. For Merck, the exciting bit will be, that their Winrevair asset. Then you do have got a very interesting readout, Atlas this year, which is an ulcerative colitis drug, and we'll see how their HIV portfolio sort of reads out. The reality for Merck is that the company highlights that their pipeline has got close to a $70 billion opportunity. And if you look at Keytruda, that's a $35 billion peak sales cliff, which is much closer. So between now and 2028, a lot of that $70 billion pipeline opportunity will get unlocked. And that is why the market is getting quite excited about Merck, right? Market is not excited about obesity and Merck. I thought the question was more about the overall result season.
No, that's a great answer. That's also all the time we have, so we'll have to leave it there, but a good conversation. Thanks so much for your time. Appreciate it.
Thanks. Bye.
That was Rajesh Kumar, head of European Life Sciences and Healthcare Equity Research at HSBC. After the break, we will get more on PepsiCo's latest results as the company cuts prices of some of its key brands. We've got more on that coming up next. PepsiCo is cutting prices by as much as 15% for key brands, including Lay's and Doritos, in a bid to lift sales by offering more affordable products. Let's get more on the company's latest results from Filippo Falorni, Director of U.S. Beverages Analyst with Citi Research. It's good to have you join us, sir. Thanks for taking the time.
Thanks for having me on, Lindsay.
So the big news, obviously, PepsiCo reducing some of its pricing, also right before Super Bowl Sunday. What do you make of that?
Yeah, no, absolutely. Look, this was definitely a concern from investors. It's been like a concern from a volume standpoint, the growth in the Frito-Lay business. That's because if you remember from the period of 2021 to 2024, US CPI was extremely elevated, and companies across the food and beverage space took significant pricing in that period of time in the double-digit range for a couple of years. So the volumes really got some impact in that period. And now with, given there's not really a lot of incremental pricing, you're seeing a situation where volumes have been negative for the last year. So companies are trying to stimulate volumes now with price reduction. So look, it's definitely a step in the right direction, I would say, in terms of like trying to reaccelerate the volume growth. We have to see the elasticity or the benefit on volume in response to these price increases. But the company sounded very confident on the earnings call, talking about already positive sign with some retailer where they tested this strategy, and also incremental shelf space gains with some key retailers in the US.
Yeah, I mean, confident as well by increasing the dividend as well by about 5%. So that obviously shows confidence in a company, I would assume. But like any company can only lower their prices so much, right?
Yeah, absolutely. I mean, look, there's going to be a limit on how much these interventions are going to be and how prolonged they are. On the call, the CEO, Ramon Laguarta, mentioned that these price interventions are going to be surgical. That's the word that they use. And so they're going to look at like price pack. They're going to look at certain retailers. They're going to look at certain geographies where consumers are feeling more the pressure of high inflation over the last couple of years. And so they're going to be, and not across the board, right? So they're going to try to really stimulate the volume on a brand by brand basis, on a channel by channel basis, and even on a pack by pack basis. So again, we have to see like how prolonged these price intervention are. But the interesting thing is that they are combining that with also with innovation, right? So they are reformulating part of their portfolio to remove artificial coloring, like the Naked line on the Lay's and Cheetos and Tostitos line. And so it's a combination of innovation, price intervention, and so they are hoping to get volumes back to growth in the snacking business.
And how quickly do you expect to see results from that was going to be my next question, in the next quarter?
Yeah, so they're hoping to get some positive results in the next quarter, so in Q1 26, but really it starts to kicking in even more into Q2, because remember, a lot of retailers, they do their shelf space reset around March, April timeframe. So really you'll see some impact towards the back half of Q1 and then even more into Q2 of 26.
Okay, so let's talk a little bit more about Elliott Management Investment as well. They took out a $4 billion stake in the company last year. Part of this whole price reduction is something Elliott Management pushed. What do you make of the stake that the investment company took out, and how they're kind of moving things around on the inside?
Yeah, look, some of the strategic initiatives that Pepsi announced, they've been in collaboration with Elliott. In early December, Pepsi and Elliott issued a joint statement where they essentially said a lot of the strategic initiatives, including the price reduction, including the innovation, have been discussed by company's management with Elliott involvement as well. So clearly this is being in coordination. Look, I think clearly Elliott pushed Pepsi to act quicker because one thing that they've mentioned a lot also in recent earnings call is that they feel a bigger sense of urgency to really turn around the Frito-Lay business, which has been really the biggest underperformer if you look at the Pepsi portfolio, because their beverage business in the US has been growing in kind of the low single digit range. And the international business for Pepsi, which is 40% of the company, is growing in the mid single digit range. So the weak spot has been the Frito-Lay snacking business. And so Elliott definitely pushed Pepsi management to act quicker and with a greater sense of urgency to fix the part of the business.
Why is that, though? I wonder what some of the challenges and headwinds are for the company. I know there's a lot of conversation with companies like Pepsi that the whole weight loss drug sector is kind of affecting companies like this.
Correct. So there's different reasons, right? So pricing is definitely one that they're trying to address because, again, as I mentioned before, from 2021 to 2024, companies took significant price increases in salty snacks to the range of high single to low double digit every year. And so one of their argument is those price gap and the value equation to the consumer wasn't there anymore. And so they need to address with affordability, and that's one of the part. The second part, as you mentioned, is definitely some more structural concern for the category, including the increased adoption of GLP-1 drugs. So on that part, they're working more on product reformulation, including increased protein in some of their snacking options. So they're going to launch Doritos with protein. That's one of their initiatives. And then the last headwind that has been there significantly is it's kind of like this whole broader health and wellness trend and consumers in the US being more conscious about what they're eating, reading the labels. And that's part of the strategy has been the reformulation on removing artificial sweetener, artificial coloring in some of the food products. And that is already in the market with the Naked line that they launched recently.
So interesting. Okay, we'll have to leave it there. Filippo Falorni, U.S. beverages analyst at Citi Research. Appreciate your time today. Thanks so much. Coming up, a new report highlights how the Canadian economy is currently on life support, and we got more from David Rosenberg about that. That's next. South Korea's Hanwha may sail a submarine across the Pacific this summer as competition intensifies to land Canada's submarine contract. CTV's Judy Trin has more in this report.
A deep dive into what could be the biggest defense procurement in Canada's history, the purchase of up to 12 submarines.
Because this has now evolved into a government-to-government situation. It's a big, big procurement. This is going to be a relationship with the winner for years, decades to come.
To persuade, the South Korean Navy plans to sail the KSS-3 submarine across the Pacific and dock in British Columbia, a journey that will take 2 months.
Your hands up here.
Okay. CTV News also got to see Hanwha's pitch up close. We couldn't film because of security protocols, but the attack submarine holds about 50 sailors. It launches vertical missiles that target land and has torpedoes. But the deciding factor will rest on economic benefits. To win the contract, Hanwha is pledging to help hard-hit businesses, like investing $345 million in Algoma to buy its steel and help it build a plant to make beams.
It's been tough as tariffs have been in place for a year and half of our business has gone away.
While some companies are hurting, others are looking for ways to expand. Using robotic technology, Hanwha builds 45 ships annually on its assembly line. Speed, Ontario's shipyards want to emulate.
I mean, what they do here is cutting edge. It's absolutely fantastic. If we can bring just a fraction of that to Canada, I think us as a country would be a lot further ahead in our shipbuilding endeavors.
The deadline for Hanwha and TKMS to submit their bids is March 2nd. It's a deal that could be worth $100 billion spread over more than 3 decades. It's investment that Canada needs to protect itself from Donald Trump's trade war.
A new report by Rosenberg Research shows the economy shrank in 2 of the last 3 quarters, putting the economy on a clear recession watch for 2026 and putting Canada's economy on life support, according to that report. And we got more from David Rosenberg. He's the founder and president of Rosenberg Research.
The bank has cut the policy rate by 275 basis points. Of course, the only people that borrow at the overnight rate are the banks. And nobody borrows at that rate, and other interest rates haven't fallen nearly as much. When I see the proof of the pudding's in the eating, question is, since the Bank Canada started cutting interest rates in the spring of 2024, what's the Canadian economy done over this time span? And it's barely better than a 1% annualized growth performance. And although the population trends have slowed with the immigration rule changes, real per capita GDP in Canada is still declining. That has not been arrested. So, yeah, I would completely agree that the Bank of Canada probably never should have gone to 5% to begin with. So we came off rates that were very elevated. But it's clear to me, unless the policy lags are just a lot longer this time around, that if this is what 275 basis points of Bank of Canada rate cuts delivers, the grand total of a 1% growth economy, the next question is that all you get?
This kind of reminds me of the interest rate policy in the wake of the 2007, 2008 banking crisis. Low interest rates didn't seem to stimulate growth then at all.
Well, it's, Tiff Macklem wasn't wrong that a lot of the, call it structural issues with the economy are developments that transcend the power of the central bank. But at the same time, if I were in Ottawa and I were in his shoes, I would be doing all I possibly can. Inflation in this country is not really an issue. Virtually every underlying inflation measure is comfortably within the Bank of Canada's comfort zone. And the economy is growing below potential. And the Bank of Canada's own forecast, when you dig through the details, is for this disinflationary output gap to be with us, not just this year, but through the end of 2027. So I'm a little surprised that the Bank of Canada is taking such a strident approach. I do think that they will be compelled to cut rates further, even from this egregiously low interest rate. And I think the Canadian dollar, which I had been bullish on tactically, is going to come under some renewed downward pressure at the same time, because there's a case to be made that the Fed probably doesn't do anything at all, at least through the first half of the year.
We have a chart from you guys just showing real GDP year-over-year percent change going back to 2022, and it shows a relentless decline. Yeah, we're running in growth, I should say. Sorry, go on. Sorry, David. Yes, go ahead.
Well, yeah, we got the monthly data late last week. The GDP trend is running at roughly 1%. The fourth quarter sequentially, as you mentioned in your preliminary remarks, is probably going to be fractionally negative. And I'm trying to look around for, what the source of vitality is going to be. I'm really quite surprised that most Bay Street economists have an inflation view, or at least some of them do, and that everything's going to be fine and dandy because we're going to get a modest amount of fiscal stimulus. I think this is still very largely a show-me situation. I'm looking at just a broad array of indicators, and it's quite striking. You would think that of all the sectors that would benefit from what the Bank of Canada has done, you think would be the housing sector. But if you look over the past year, residential construction expenditures are flat as a beaver tail. Home prices, everybody was telling me back in the summer of 2024, when the Bank of Canada started to cut interest rates, people were saying to me, oh, just wait, they're going to reignite renewed rounds of housing inflation. None of that has happened. In fact, home prices in Canada nationwide have either been flat or negative sequentially for 10 months in a row and are running negative 2% year over year. And then, we were hoping up until recently that there was some sort of detente with Donald Trump, that his relations with Mark Carney were starting to improve. Well, of course, we can throw that in the waste paper basket right now. But, you're taking a look at manufacturing activity in Canada, even with what would be deemed a competitive exchange rate and red-hot U.S. economic growth that you'd think would be pulling in Canadian shipments. Manufacturing is actually down 5% year over year. Like, you're talking about a recession. Well, you have a recession already in the manufacturing sector. And there's no real thrust in terms of retail sales. When you adjust for whatever inflation there is at the retail level, there's practically no growth there either. And that, of course, is very interest sensitive. So it comes back down to, your view on the Canadian dollar is basically if manufacturing and exports, it's incredible. Exports are lower today, the level of exports, than they were in the spring of 2022. And they're also running negative year on year.
That was David Rosenberg. He's the founder and president of Rosenberg Research. Market Call is coming up next. Tim Reagan will be on the show. He's managing director at King West & Company, and his focus today will be North American large caps. Also, join us this afternoon at 3:10 Eastern Time on commodities. We will be sitting down with the CEOs of Foreign Mining and Eldorado Gold to dig into Eldorado's acquisition of Foreign in a move to create a leading gold and copper producer. That's later this afternoon. And we'll take a quick look at how markets on Bay Street and Wall Street are trading throughout the afternoon. We'll start with the TSX. It's up by 0.4% at the moment, but some interesting stocks to watch on the TSX because of the Anthropic effect. We're watching that today. Anthropic's new AI tool to help streamline legal work for companies is sending a couple companies down. Thomson Reuters falling as much as 17%. This is the biggest intraday drop on record due to increased competition, now down more than 18%. CGI also down almost 9%, and Descartes falling the most in 14 weeks now, down almost 8%. That's it for us. Thanks for watching Morning Markets. We will see you tomorrow.